All right, Hunter. Well, we're about three quarters of the way through earnings season. There have been some really interesting developments and some major takeaways that I want to talk about to our listeners here today about what corporate America is saying on these earnings calls, how things have developed. Obviously, we're in this very uncertain time. So it's really interesting to get that feedback from these companies and see what they have to say.
Yeah, there's been a ton of movement going on in both, the commentary surrounding earnings, but also earnings season we're on the tail end of. And it's really, in a nutshell, been good, very resilient, a lot better than a lot of people were expecting, especially driven by those big cap tech companies, which make up a large percentage of the overall stock market. So if big tech is doing well, then the S&P and the NASDAQ especially are probably doing pretty well. And those earnings have held up pretty well.
And I think it's interesting because when we came into this year, a lot of analysts, even pre-tariff, pre-Trump administration, were already going to expect some kind of slowdown in the market. I mean, obviously, we came off of years in 2023 and 24 where the market really ripped. Companies performed extremely well. You had U.S. corporate exceptionalism kind of at all-time highs, and they're already expecting some kind of slowdown. But to your point, companies, especially the big tech ones, have performed really, really well. But I think what's been interesting is now you're getting the commentary, you're getting the results from the first quarter, which was really unaffected by tariffs because those major announcements came, beginning of April. And these are the quarters of, call it January through the end of March. But now uncertainty is at a, enormous high. And so companies aren't really sure on a go forward basis. And I think what we've seen over this earnings season that's been really interesting is a lot of companies are either just kind of reiterating their forward guidance because they say, hey, I don't know, maybe we had a really great quarter, but we don't know what it's going to look like for the rest of the year. So we're just going to say, we're not going to raise guidance and say, oh, we think we're going to do better based off of this first quarter. And then in some cases, you even had companies completely pull their forward guidance, which is not very common. That's only going to happen in seriously uncertain scenarios. The last one that comes to mind is really COVID, when you had such an uncertain environment where companies say, hey, we don't know what's going to happen to our business over the next 2, 3, 4 quarters because of this, shakeup in tariffs in the administration. So we're just not going to provide guidance. And a lot of big companies have gotten to that point. Mergers and acquisitions have slowed down, and a lot of business activity is just kind of slowing to a certain extent. We'll kind of get into some of the details around this, but I think it's fascinating to see some companies just saying, yeah, kind of business as usual. We're just going to see how things shake out, or say, hey, we just can't provide forward guidance right now because we really don't know what's going to happen.
Yeah, and I think that's a really interesting thing to take a look at and just be aware of in general is that, I've seen some companies reiterate their guidance X tariffs. Well, it's hard to live in an X tariffs world when tariffs are very much part of the reality. And along with that, you always have to ask yourself if a company who's pulling forward guidance is pulling it because of tariffs or just using tariffs as an excuse, because we saw that a lot during COVID or, other times of uncertainty where there's a big excuse for companies who may not be doing well or having a few hiccups to just easily, blame tariffs. And then now I'm absolved of this issue and I have a few more quarters to, buy some time and then figure out my business issues, even if they're totally unaffected or materially unaffected from that. Getting back to the big tech earnings, we had Google or Alphabet, Facebook, Meta, and Microsoft. So Alphabet, Meta, Microsoft, they all reported very good earnings. A big thing with them was the CapEx plans were mostly unchanged, reiterated, or even enhanced in some cases. Of these companies are very much still on the AI train, still investing heavily in that. And they're not slowing down for some, what in a lot of views is, either short-term or short to medium term uncertainty. They're charging ahead and not taking a step back. The one big exception we saw was Apple. And that's something that we've been concerned about for a while is they're heavily tied to China. They have, about 4/5, 80% of their products coming out of China. And despite trying to make inroads in India and build new manufacturing plants there, it's always been a nice to have and not a need to have. And so now that tariffs are here, they're only a fifth of their production shifted over to India. So they do have tariffs to worry about to a very real extent. As we've mentioned and we'll mention later, it's tariff dynamic is constantly changing, but we're looking at the Chinese tariffs as probably not coming down to, near zero levels. At least they'll probably come down from the current 145% or so, but they're not going away. Other countries such as India, they'll probably, hopefully, reach a trade deal that'll be more permissive to them. But Apple being the exception, that they're still very tied to China. And then finally, we're still awaiting NVIDIA's earnings. They're always very late in the cycle. They have a different fiscal year than everybody else, so they haven't reported yet. But that's the big one that everyone's looking forward to at this point, now that you've had most of big tech and most of the S&P report earnings already.
Right. And I think their results heavily hinge on these other big tech players. So, all of these good big tech announcements, ex Apple, pave the way for NVIDIA to have a good print. And that's been kind of the main takeaway from these big earnings calls that we've seen, is that AI CapEx spending, data center CapEx spending has continued to stay elevated or even ramp in some circumstances. Even Apple is spending a huge amount in CapEx between shifting a lot of production to India and also on data center infrastructure. I think it is important to note in regards to Apple too, they did get an exemption from tariffs, but they did note during their earnings that they're still going to take about a $900 million hit because of those tariffs. So, Apple's a huge company, at over $1 trillion, always kind of up there as far as the number one biggest company in the world. But that is still a pretty big hit to be taking almost $1 billion because of these tariff implications. They did note that, iPhone and other Apple product prices will probably have to rise at some point in the future if we don't get to a more normalized tariff situation with China. So that part's really interesting. But I do want to kind of stick with the takeaway of the fact that AI spending's big, data center spending's big, because every time these new, and we've talked about this a lot on other podcasts about AI and the developments there, but whenever you hear rumors like Microsoft might be stepping back from some data center infrastructure, well, they kind of talked about that on their call saying, hey, yes, we have some lease optionality, but we are still putting a ton of money into data center build out. And so I think that's really the biggest takeaway that I got, was wanting to read the tea leaves from those companies, because you have to have these CapEx rollouts in order to pave the way for greater company earnings in the future. So if they don't invest in the infrastructure now, it's going to prolong the time it takes to ramp that revenue, ramp those earnings, and it pushes out your costs. So I think if they can get that in now, build the infrastructure, and then benefit from it later, that's going to be good for those companies.
Well, especially in technology, where once you get behind the curve, it's really hard to catch up. And so none of these companies want to be the last one in. They always want to be, stay at the front of the pack, because that's the easiest place for them to be, if they can maintain that position. It doesn't do them any favors to hold off for a year while everyone else makes these investments, takes up all of the available data center space, and then your marginal stuff is all new builds and stuff, and they're stuck with the hard to build stuff, maybe even, electricity constrained in a lot of markets. So it is good for them to, stay on top of it and continue with that. On the trend of people pulling guidance, as I mentioned, is one of those things that you have to take with a grain of salt. Why are they pulling this? There's sometimes very good reasons. Like we had GM pull guidance, UPS, Cummins, that's all very, logistics, transportation-based goods and trade-based stuff. So, a reduction in imports obviously going to affect these companies. That makes a lot of sense. Similarly, you had several airlines, you had American and Southwest specifically pull their guidance, there has been a reduction in US based travel, US to other countries, as well as Canada and US travel back and forth. We've seen those flights drop off a lot. And that is very important for specifically these carriers. I think one thing to note is that globally, airline travel is still very strong. And so companies who have a lot more exposure into the European markets, into the Asian markets, they're still, going to pretty much do fine. But the US based stuff is where that biggest hit has been seen.
Right. And I like what you said earlier about companies using this as an excuse, because the one that you didn't mention that pulled their guidance was Snap Inc. So Snapchat. I mean, let's be honest here. How much is Snapchat tied to the global supply chain and the tariff situation? Sure, maybe if they, have some clients in China or customers in China who decide they don't want to use the platform anymore because it's a US based company, I can see that, but I think they're kind of using this as an excuse. The uncertainty of the macro environment, that didn't make a whole lot of sense to me. It makes sense when you talk about the logistics companies, but I did think that was really interesting. And so to kind of get to the tariff situation, I always like to see the keywords that companies are using on their earnings calls. And we saw the word tariffs used across 93% of earnings calls this cycle. So even companies who are not even attached to tariffs by any means, you could be a consumer software company, are still a lot of times talking about tariffs and the implications that they have for markets. Words like uncertainty and recession also hit, relative highs in these earnings calls. And I think it's important to track because companies are really trying to prepare for a variety of scenarios when it comes to the tariff situation. And that's, of course, the biggest theme for what these companies are talking about in the current environment, just because of what an uncertain situation it creates for them. And especially if you're talking about companies that are really tied to logistics, really tied to freight, moving things across the world, those companies, really have some serious implications as far as how they're going to conduct their business on a go forward basis.
And to that end, companies, as we saw in Q1 GDP numbers, especially pulled forward a bunch of inventory. These tariffs were announced and even, seen coming for a short while beforehand. And companies had the opportunity to pile on inventory in the meantime and get ahead of the tariffs before they really were enacted. And that had a huge effect on GDP this quarter. But just for reference, exports were up 6.7% year over year, whereas imports were up 27%. That's a huge difference and really goes to show how much we were importing more than usual. And this wasn't even, a down quarter last year or anything. This was by far and away, one of the largest import quarters, perhaps on a notional basis, the largest we've ever had. And while we always run a trade deficit, this was, incredibly high relative to what it even normally is. And we're seeing container ship bookings coming from China down 40% year over year. That's huge. People aren't contracting out these ships anymore because we've had the tariffs announced for a while, since beginning of April, but just now are we getting the first container ships that are really getting hit with those tariffs, because you had delays, you had grace periods, and then finally you have a time that if the ship left China before the tariffs were enacted, then that ship is like grandfathered in essentially. And so only now are we seeing container ships really getting hit with huge tariff numbers. And so that's when we'll probably expect to start seeing some fallout from this, some prices change, some, availability of certain goods change. But again, we have those huge inventories on shore to kind of buffer us in the meantime.
Right. And I think it's interesting because we also got the Q1 GDP numbers very recently, and net trade, because of how big of a deficit. So trade, if you have a trade deficit, meaning you're importing more than you're exporting, it's a negative factor in GDP. And, whether like how relevant that necessarily is to gross domestic product is probably not the best indicator when it comes to how it impacts it. But we saw that it actually shaved off 5 percentage points of GDP, which is huge. I mean, a 5% GDP run rate is very high on a year over year basis. I mean, that's pretty exceptional growth. Usually the US is looking somewhere in the 2 to 3 percentage point range. But if you're shaving off 5 percentage points because you're front loading so much inventory in the month of March and the early part of April, it's really fascinating to see how it impacts such a big number like that. And companies are obviously looking for positive trade resolutions. And they're hoping that this inventory can last them through this cycle. And as of time of recording, we haven't yet seen a trade deal. We're hoping for one in the coming days, more in the coming weeks. I think it seems like the administration is getting closer and closer. So hopefully these companies will have a little bit more certainty on a go forward basis. But to your point, you had a lot of inventory coming into the US before, and shipping rates, freight rates have dropped substantially just because companies are pulling back, taking a wait and see approach to everything that's going on right now.
Yeah, no, they definitely have. And it'll be really interesting to see where we're at next quarter when we're talking about those quarterly earnings, those, effects that we can actually measure in the markets then. In the meantime, for Q1, like we mentioned earlier, earnings have stayed really solid. The, blended earnings growth rate was 12.8% in Q1, which is still good. Low double digits is great earnings growth rate. Higher than, traditional S&P returns. So, that's pretty encouraging to see. And on a price to earnings basis, the S&P is sitting, a lot closer to a 5-year average than it was in the past. We were talking, kind of end of last year, how the S&P valuation was getting a little high on a broad scale. Again, we always like to look at the underlying companies and find those that either are valued well, or at least their valuation makes sense to where they're, super high growth rate. Okay, maybe you deserve a little bit higher PE. But on a broad S&P 500 level, we're back down to 20 PE, which is about our 5-year average. It's back in line where we're not really worried about broad valuation being an issue for the S&P.
Right. And I think it's interesting that you bring up the valuation, because, on that price to earnings basis, obviously that comes into a lot of the fundamental factors when you and I are looking at specific companies, but you can look at it market wide, like you just said. And a lot of times when you have a larger PE, it's because the price has gotten away from you, or grown to a substantial point. In this case, you also have the factor of earnings expectations are coming in to some extent, because whenever we're looking at a price to earnings ratio, that earnings figure, so the price is today, but the earnings are the expectations over the next 12 months. Well, analysts have brought that in from $274 of earnings on the S&P 500 to 266 over this most recent quarter. So that's what their expectation is for calendar year 25. I want to clarify that because we're already into it one quarter at this point. But it does show that analysts are also expecting lower earnings from the S&P 500, but it's still marking earnings growth over last year. To your point about the 12% earnings growth quarter, from a year ago, Q1 of 24, that's pretty substantial earnings growth. I think, especially after seeing the big tech earnings and them really, give a lot of confidence to the market. What you've done is really kind of raise, I think, the floor on the S&P 500, created some valuation support there. So while you do have this uncertain environment, I think it is a positive for the market that you have pretty solid earnings flowing through. And even though analysts are bringing in those expectations, things still look, fairly positive from a growth standpoint.
Well, and then back on kind of the messaging of the whole thing, I think it's a pretty easy thing for analysts to bring in their EPS estimates. No one's going to judge you for suggesting lower EPS growth this year, but they're going to be a little bit more curious if you're raising your expectations. So I think that's just a kind of an easy call for a lot of analysts. There is real macroeconomic reason to maybe shave a little off the top side of expectations. But, again, one of those things you have to kind of look at the reasoning behind it. And, to that point is that earnings really depends on what developments we see. We've seen a pause in the tariff implementation. We've seen a few allowances here and there. And that's bought people time. We've seen inventory onshore, and that's also bought people time. And what will really dictate how the rest of the year goes, if they hit those EPS figures or not, is what trade developments we see. We have talk of deals, we have talk of deals, but we need some actual deals before we actually get clarity on what's going forward. And then one final point I want to make on the subject is that, maybe it's just my general bullishness in the world, but my belief that American exceptionalism isn't gone is that corporate America generally finds a way. They've been hit with a whole slew of issues in the past, and whatever it's been, they generally find a way to navigate around it and make the best of a bad situation. It's easy again for companies to complain, Snap to pull their earnings. Oh no, it's not my fault, I swear. But at the end of the day, they're still running companies that they want to make money and want to survive and thrive. And so they pour lots of time and money and effort into rerouting trade, or reducing the reliance on China, whatever it may be. They generally find a way to navigate around it and come out on the other side, healthy and strong.
Right. And I think that gets us to our takeaways and how you and I are feeling about the current investment environment. Obviously, we are allocating and being strategic about capital right now, trying to decide where are the best places to invest. What do we feel strongly about, and what gives us, some confidence or pessimism on the other side about what's going on right now. As I mentioned, I think the strong earnings, especially from your bigger companies, do help raise that floor on the S&P. We could certainly see some retracements back depending on trade developments. But I think it does help support your current valuation, given that earnings are a little bit stronger. And then also, I think the really critical part, and I love reiterating this for people because it can be very confusing when you're in a very economically precarious situation. Say unemployment's risen, take COVID, for example. You were in the midst of a pandemic, and just, after that short dip and very fast and deep dip in that March, April timeframe, markets resume their upward trajectory rather quickly, and you're hitting all-time highs by the end of the year. Well, you can be in the middle of an economically precarious situation where things don't look good on Main Street, but markets can look good on Wall Street because of the forward-looking nature of the stock market. And I think that's important right now, because what you're seeing right now is we've had a little bit of a comeback in the S&P 500. The market dipped over 10% and has since come back almost to kind of the point that it was before, still down for the year, at least as of the time that we're recording this. But if we can get some of these trade deals in place, before the economic pain kind of starts, because there's no doubt that this tariff situation will create some problems for Main Street businesses, whether that's their sourcing inventory or just going through daily operations. It will result in some increased prices. But if you can get trade deals in place that make the forward looking picture better, then the market can remain supported. Well, if you start to see the economic data worsen before you get trade deals in place and there's no positive forward looking expectation, then I think we'll see that retracement back downward in the market. So it's really about the timing of these trade deals and how quickly we can get them. Because if we get things set up in place that give analysts, Wall Street members confidence in future expectations, then we'll be able to stomach any bad economic data prints, because people will largely just write those off when it comes to trying to decide what the market should be valued at.
Yeah, and that's a really good point, is the forward-looking nature of the market and how important that is to what stock prices actually do. But given that, and given the uncertainty that there is currently in the market, like we mentioned on a podcast very recently, talked whole podcast about it, markets hate uncertainty. And to that end, it's still prudent to, be cautious. It's, look at other alternatives to, some of your equity portfolio allocation. We also just did a podcast on kind of your more fixed return options. That one's titled "What I'm Investing In That's Not Stocks." Talk about a lot of these, whether it's private credit or credit adjacent products. Also equity linked stuff that's fixed return, or relatively fixed return, not guaranteed but fixed payoff kind of thing. Is there a lot of other options that can help you tick along up into the right through environments like this, that don't take so much of the downside risk that's in the markets currently? It's not a time to be selling all of your equities, but it's not a time to be buying your 1,000 PE unprofitable growth stock.
You're exactly right. And that's why I think it's so important that, especially right now, and we preach this in our business, is that and what we specialize in is equity investing. When you're buying individual stocks, focusing on company by company fundamentals, because this is an environment where some companies are vastly and impacted vastly differently from others. I mean, you've got some software companies that are relatively unexposed to tariffs, and some consumer product companies that are totally impacted by tariffs. So being able to be strategic and tactical in this environment is really beneficial. I think that if you're talking about broad market investing, then you can invest. If you have a long time horizon, you can invest right now if you want to. I think we're going to see future all-time highs in markets. It's just a matter of time. So if you've got a long time horizon, then it's always a good time to invest. But certainly on any kind of retracements back in the S&P 500, I think retail investors can go ahead and allocate money to broad markets if they're not working through an investment manager like ourselves, who's doing the individual stock investing. Because that's actually exactly what we saw over this April tariff timeframe, when markets in the S&P dipped back to that 5,000 level. A lot of retail investors said, hey, I've got a long time horizon. I don't really care what happens over the next year or so. I'm investing for the long term. I'll go ahead and allocate money here because we got a little dip, and then you just ride it out. So I think we always like to preach it's always a good time to invest. I think it's important, especially in the near term, to be tactical. And that's how you and I are really approaching it.
Yeah, exactly. And to your point on the retail investor, they don't get props ever. They get, the financial media doesn't view the retail investor as a very sophisticated investor, but I will say, call them out a little bit here, that they kind of won that trade on the hedge funds, because on the deepest of the dips that we saw, it was mainly hedge fund selling, and retail was actually a net buyer through that time period. And, I'm not going to say we're not going to retest lows, but from then till now, we are up, several percent, and, hopefully get some trade deals done and get through this. We'll continue to march higher, and, the retail investor will come out on with the upper hand on that trade there. But I think, just to wrap it all up, is that Q1 earnings season was on the net good, especially considering the macroeconomic environment. We're definitely not out of the woods yet. There's a lot still to come, and a lot that we need to see in order for equity markets to move higher or even stay flat. There's been some pricing in of trade deals happening in the future. If we don't see those, then we could retest the lows. But it's I'm feeling more optimistic than I was a month ago. And, I think as time comes along and hopefully we get some trade deals done, that will just build upon itself.
I agree. Could have said it better myself. Thanks, Hunter.
Thanks, Victor.